All right. Hello and good afternoon, everyone. It is 2 o'clock on Friday. Actually, it's 2:01 on Friday, and we are going to get going. My name is Burdett Tatum, and I am the founder and CEO of Tatum Accounting Services. And this is our weekly support and training call that we do for our business office leaders. I'm very passionate about this call and enjoy the time to just get on here and talk through everything business office. If you've listened to any one of these in the past, our push on this call is to really look at the impact that your activities are having on the financials. So your daily, your weekly, your monthly routine, from billing to ancillary charges to moving in residence, moving out, the different things that the different financial data that we have to capture. We want to look at how does that line up with the financials, balance sheet, income statement, um, each example we're looking at, and just making sure that it makes sense. And for a goal of trying to build a business IQ, just better understand the financials for your community. You can better support your presidents. If you're on this call, you can better understand just the financials and the how each activity is impacting your reports. So last week we talked about monthly revenue discussion and P&L activity. So basically, we just continue to look at our example, looked at a couple months billing. We even played with some incentives to show, hey, if an incentive is put in this period, or what if it was missed, put in that period. We'll do a bit of a recap. We like to do a recap each week, just so it's clear and fresh. We're always challenge you all to go and look at your own financial statements, right? Go look at a balance sheet, go look at a P&L and see if you can identify some of the things that we've talked about on this call. So this week, on the call last week, I said, the next week we will look at maybe some ancillary charges and more move-ins, but I want to kind of veer off a little bit and talk about bad debt, really. Some of that was started on the last week's call, but I want to dive into more on revenue, but look at the impact of bad debt on the financials, because that's a big piece, and it's important to understanding when we're saying bad debt. We're going to get into some of the nuts and bolts on the accounting side, but we won't dive too deep, because the object is to just understand, hey, when I see that, when I hear about allowance, what does that look like? So we are going to jump into that. So I'm going to pull over our template that we've been working with each week, and we're going to dive in and just take a look at some of that information, if you don't mind. So here we go. All right, so again, last week we looked at a couple different months billing, and so to recap, we have our balance sheet, we have our income statement. We've got an income statement that's showing monthly activity. And so we looked at some monthly billings and what that looks like and all that stuff. I'm going to wipe the slate clean, and we're going to run through this example and just get an idea of what we're looking at. So as you know from the balance sheet, like we've talked about many times before, and then sometimes hearing this information over and over again really helps it sink in. Again, done a lot of trainings with business leaders, and it's never the first time you say something, it's like, oh, I get it, and I don't need to hear it again, right? Just in learning in general, if we hear things multiple times, if we're able to apply things, again, that's why I'm gonna challenge you guys to don't just hear it on the call, but go back and, again, look at your financials and look at your ledgers and just see if some of this, if you can identify some of these things, if some of the information given is your first time hearing it. A lot of this, we know that you've been in the industry, so you know a lot of these things, and we just want to come, alongside of you and make sure that the financial understanding is there and how this is impacting everything. So we know when we take a reservation and we get money in the bank, and prior to a move in, we know there's a reservation deposit on the books, there's a liability. And so we can see this happen real time when we have the balance sheet and income statement stacked against each other or alongside each other. And so like we talked about, when we go through the steps of moving a resident into the building and seeing how the charge is going to happen, the prorated rent based on the date that they moved in, and seeing how we're going to then recognize that liability and take community fee, and then moving on to, okay, depositing the check and then notifying the ledger in our accounting system, the cash is in the bank, and the ledger is happening. We get to this point where we have cash in the bank now. We've collected everything that we've charged. In that instance, there was no incentive. Now, to add an element to the scenario from last week, you know, we collect another deposit, okay? And so cash goes up and we have a reservation deposit. Now, we've already talked about when we put the charge out there, the AR goes up and then the liability is there. Then we get the cash in the door, then when cash goes up. So we've kind of sped past that example because we've looked at the slow breakdown here. So ultimately, we have another $5,000 in cash, and we have another $5,000 in liability because we've taken two deposits. Remember, at this community, the reservation fee is going to be $2,500. The deposit is going to be $2,500. Okay, and we looked at, all right, so now let's do another month's billing. And again, notice how that $5,000 cleared and it went to income, just to show the full cycle. And it's related to these two residents. So we had two residents moved in beginning of the month. So this was also the community fee that's attached to those two. Okay. And then we've got the full month billing of the resident that was in July. Now notice, and I want to go back to this and go slow, but notice that, you know, we look at our cash and we're looking at AR, that's a total of the 19,000, right? Which that 19,000 ties to the year-to-date P&L. But notice the 8,500, like where does the 8,500 AR come from? Right? It has nothing to do with the community fee because the AR for the community fee was already recognized when we put the charge on the books and AR went up $5,000 and we received the cash, right? So that's no longer sitting in AR, right? We know it's not any of this because this was paid, right? This was paid back in step 4 and 5, okay? So our AR is the new billing less the incentive, and that's our 8,500. Okay, so the billing that we did for August, the two new residents, the full month from resident that moved in the last month, less the incentive that the memory care resident receives in this scenario is what we have of AR to collect, right? It wouldn't just be the full total, the 15.5 because we're giving an incentive. So that's why AR is at 8,500. And again, we're always in balance. Total assets equal total liabilities and equity. Okay. And so let's do another month billing like we did, and we're going to bill, rents are going to go up, right? We're going to bill again, rents are going to go up. Again, fast forward past the fact that, yes, we should be receiving payment. We should be receiving checks from our residents each and every month, okay? We looked at a little bit last month of the incentive example, right? In a case where, you know, two scenarios. One, understanding that you capture incentives at the time of move-in. So this incentive would have already been in the queue. So when we bill for October, that's when it's going to hit. So this is not a case like, oh man, I forgot to put it in. But if it was, right, and we had an incentive that was supposed to hit in August, but we had to go back and put it in manually. Again, like we talked about last time, we're kind of blowing up the October financials by missing $7,000 worth of incentive that should have been hit in August. But we'll hang with the example of this should have gone in October, but we've already accounted for it when that resident moved in back in August. And your property management system is going to allow for that. And we want to be able to take advantage of that, which goes back to earlier conversations of understanding the incentives and having a good language between the sales team, what they're offering the residents, and then what the business leader understands those incentives to be, having the good communication there. All right, and then we do another month billing in November, and again, AR will continue to increase until we get that cash in the door to bring in AR, right? So something else that we've already stated, we can look at a P&L and see year to date, hey, we have revenue of $65,000, but yet we've only collected 10,000 of that. We've got another 55,000 to collect, right? So accrual accounting, billing and having revenue, that's great, but we've got to get cash in the door. And I'll never get tired of saying that on these calls because it's so important just in any business, right? When we're providing services out there, we want to make it easy for our residents to pay us. Hence the topic of today's call when we get into bad debt. But just wanted to make sure that's clear. So we did another month of billing. So here we have July through November. We've billed a few months. We see how things are being accounted for on the balance sheet. Granted, this is a simple balance sheet. We don't have fixed assets on here and other stuff, but in general, there's just going to be more accounts. And we even work up our, equity a little bit. And I guess I could have really fine tuned this, but we have all this balancing. Now, so now let's go into a bad debt conversation, right? So, and understanding why it's important for me as a business leader to understand, bad debt and allowance for bad debt and all that kind of stuff, right? Like you want to understand the accounting team's or your company's philosophy for recording bad debt, right? Whatever the mechanism is, whether it's, hey, we believe anything that's 3 months and more of outstanding in AR, we're going to be conservative and make an assumption that that's a doubtful account. We might not collect that. So we want to go ahead and make an adjustment to the P&L to capture that. And we'll look at where that goes onto the P&L. Or it could be a percentage, or it can be maybe it's 2 months, right? Or maybe it's hey, from historical trends, we typically have to write off 1 or 2% of whatever. And so this is what our allowance is going to be. Whatever it is, it's important that if you're going to be reading the financials and or even explaining items in the financials, or even just seeing it when you get your P&L, be able to say, hey, where did that bad debt number come from? And nope, that, we're going to collect from that family because I just talked to them and we've got a payment plan going, or whatever it is, you understanding what it's doing to your revenue, what it's doing to your net operating income, so you can just have a better understanding when you're reading those financials and when you're explaining those financials. So I'm going to move over here to what, an average AR agent report is going to look like. And we won't dive super deep in, but we just, in general, is going to be the resident's name, probably going to have the suite number in there. In our industry, it's probably going to have the status, whether it's a current resident, whether it's where they moved out, or they're a future resident, where we have a reservation that hadn't moved into the building yet, or whether they moved out of the building and we still have an AR balance, right? And those are probably some of the hardest ones to collect because now the residents out of our building. But we'll dig into that in a later video on how to read an AR agent. And then you'll typically have the total due column, right? Most of these, they may be presented in different ways, but they're going to have the same information there. And then the reason why it's called an agent report is because it's going to age the receivable balances, right? And so the way you look at this is the total due. This will be the current month. So going back over here, we're in the month of November. We've billed through the month of November. So we're looking at an aging from November. So it's going to go, and just to make it easy, the way we look at that, forgive me, the way we look at that is we would say, this is November, that's October, right? That's September, and that's August. And then this is anything prior to August, right? So anything prior to August is going to go in greater than 3 months, right? That's how the aging is, that when we're looking at aging, that's what it's explained. And so we see in the current month, out of the 62,000 total outstanding AR, we've got 15,000 for November, 15,000 for October, 15, and so forth, all the way into getting here, which is and then you would have a prepay column. So any times we get payment ahead of any charges. So some residents may pay at the end of the month for the next month's billing. So they would have a prepaid when you run the aging. And then when the next billing comes out, that prepaid charge would absorb, the charge, and then they have zero balance. So then that's why you have this net due column, which is really anything of the total AR less the prepaid would be the net due. So that would be a general AR aging. And again, I put some headers up there to look at, but you were starting from November, anything aging over. So when we start to see balances that are 1 month, 2 months, 3 months past due, that's, obviously that's a huge issue. And that's why we want to be looking at the AR aging, often. right? We always preach that, hey, by the third, fourth, fifth of the month, you're looking at it, right? Rent's due on the first, if it's late by the fifth, late by the 10th, whatever your community standards are. But looking at it, third or fourth to see, okay, that big wave of folks that are paying right off the bat, then say, okay, who do we maybe need to give a gentle nudge and a reminder before it's late, right? And then between the 5th and the 10th and seeing who is paid. And then obviously by the time it's the 10th or the 8th or whatever that when it's late again, look at it again to make sure, all right, let me go and collect what I can and keeping the AR down. So just frequent eyes, get this from that, frequent eyes on the AR agent so that we're not allowing residents' balances to age too far. And then a resident moves out and now we've got to try to, play the game of trying to collect from a payer who is no longer, the resident is no longer in the building. And that definitely becomes challenging. We've seen a lot of different things. All right, so in keeping this in mind, I want to go back to a scenario and let's just pretend that, okay, we didn't get payment from any activity in July either. So you see that's put back in the agent. So we have no payment yet. Okay. And let's just say at our senior living community, anything, call it 30 days or older than 30 days, we're going to deem as a doubtful account. So let's talk about that account that's on the balance sheet. Okay. So allowance for doubtful account. That's where we are going to put our estimate, if you will, of AR that we don't think we're going to collect on. Basically, that's what's it's saying. So again, if our process is going to be anything that's 90 days or older, then anything, and this makes it pretty easy, anything on the AR aging that falls into this over 90 days or over 3 months bucket, we're saying that, hey, we're going to go ahead and make an entry into the system. Usually this will be handled by the accounting team, but it's very, very important for the business leaders to understand. We're going to make an entry on the financial statements that's going to report, hey, we don't think we're going to collect this $3,000. So therefore we need to reduce revenue and reduce AR just so that we can go ahead and reflect that information on the financials. Now, if we end up collecting it the next month or 2 months from now, great. We'll just make a reversion entry, but we want to be conservative. We've based on trends and we know that once we hit that over 3 months bucket, it's a slim chance that we might collect that. So we want to go ahead and make that entry. That's essentially what your bad debt is and have an allowance for your bad debt. So in that case, if we were doing that, we would say, all right, well, let's go with our same scenario and let's say, okay, we need to write this prorated rent off because it's hanging in our bucket for going back to our aging. What we said our scenario is, hey, it's in that bucket, so we need to write it off. The accounting team is going to make an entry to the financials. So you saw the bad debt pop up and we see there's a negative 3,000 here in the month of November, bringing down our revenue. And the offset to that entry is this allowance for doubtful accounts right here, bringing down AR indirectly. So it's not directly hitting the AR, and I'll come back to that for a moment, but it's going to hit here, bringing that down so that we have it on a ledger and saying, yep, in gross AR, if you will, we have 58,000 less what we don't believe we're going to collect on. So we believe we're only going to collect on the 55,000 in AR. So I'm going to pause there and let us kind of absorb what's going on there. But it's reduce income, reduce AR, because we previously built this back in July. But on our protocol, anything that's over 90 days, older than, greater, then we're saying, hey, we want to get conservative because we don't think we'll collect that. Now, like I said, if in December we did collect it, right, then we would just be able to reverse the interest. So then in December, you would see a positive go back on the books at that 3,000, and then we can remove this, right? And that's how we would treat that. Now, on that same note, notice though that when we make that entry, the entry is not being made on the tenant's ledger, on the resident's ledger, right? So we made the entry on the financials, but we didn't, quote unquote, write that balance off. We made the adjustment entry, the conservative entry, because it's kind of an estimate. We don't believe that we'll collect it, but we may. So just know what I'm saying there. It's not on the resident's ledger, meaning it's still going to show up on billing statements. We still have it on the AR agent. So that balance still sits out there. And so the next step in that policy says, all right, so we made the bad debt adjustment anything greater than 3 months. Now we'll give it another couple months, and we still haven't collected. Then we're going to really write it off directly to the AR agent. That's where you would take it off the tenant ledger and actually reduce AR, and then that allowance account will go back to zero. So what I'm saying is you basically would move this up here, and AR would actually be the 55,000. This will go back to zero. So hope you understand what I'm saying there. So catch that. So the accounting team make the adjustment on the financials, but that balance is still going to show up on the statements. So you're able to still track it and still make sure, like, hey, look, this balance is still due. Again, we may get payment on it. We send statements, and we may be able to get payment on it. And if we collect it, then it's just we just undo that adjustment that we made on the financials. So helpful for you, again, to understand what that looks like, understand what's the reason for it. So if I'm executive director and I'm reviewing my financials, I have November, and so I can see some trailing months in there, and I say, man, why did my revenue get reduced? I understand the 3,000. I understand the policy, and I already got the AR agent, and I'm like, okay, well, yeah, that person is over the 90 days, but guess what? My team has been pushing hard, and we feel we will collect it, and in fact, we have a check that's on the way. Right. So again, I'm owning my financials. I know everything that's going on. And when I see things hit, I know the why behind it. And I understand why my revenue is being reduced, why the AR, because oftentimes I know the business staff is not really looking at the balance sheet a lot. The focus is all on the income statement, but it's helpful to know that where this is coming from. So basically, again, our AR is reduced and our revenue is reduced, which means that we have lower revenue. So then when we subtract expenses, our net income is going to be lower. And we know we want a positive net income. So we want revenue to be high, expenses to be lower, at least lower than revenue. And then we want to have a positive at the bottom of that P&L, which is our net income. And even the additional expenses that go there, we want a positive net income, right? So how do we do that? Well, we want high revenues. We want to keep it. We want to have good expense control, right? And so we can make sure we have a good NOI. So again, being a reason of the financial statements being ones that have to explain it, whether they're doing various analysis, executive summaries, or whatever the rhythm is for your community, being able to speak to some of these things, and being involved in it and really understand, and then have that conversation come to the property accounting team or the accounting team or wherever, and saying, hey, look, it's a very slim chance we'll collect this balance, right? Because of X, Y, and Z, or this is a very good chance we will collect this balance. But the more involved you are, knowledgeable that you are, then there's some really great conversation that go on between the accounting team, and then it just paints a full understanding. And then so those reports being delivered to operators and investors are just that more impactful and more accurate, because it's got buy-in from all parties. Financial statements are not just something that accountants are doing, separate from everyone. It's an involvement of all parties so that it can be accurate and it can state correctly. So the important thing of today is I really wanted to drive home that element and seeing where does bad debt impact, what's my role in it, why does it make sense for me to understand the policy? Well, again, it makes sense for you to understand the policy. When you see it show up on your financials, you can speak to it or even challenge it and say, hey, look, I know we're going to collect that, right? Again, there's a check in the mail or whatever the case is. And then just help shore up and make sure that we don't have other accounts aging. So we know that, hey, for the month of November, this is aging, but when the next month comes and this gets pushed a month, then this is going to now move on to that bucket, right? And so that'll be $15,000 now that becomes bad debt, again, based on our policy, because it will become next month greater than the 3 months past due. And conservatively, the accounting team is going to go in and say, hey, look, based on our policy, we're going to make this adjustment, barring anything that's out of the ordinary. But if it's just, hey, look, don't have collections on this and we don't anticipate collecting anytime soon, then that interest is going to hit your financials. And obviously 15,000 is a bigger hit than 3,000, reducing your revenue if it's something that could be avoided. And by that, signing folks up on ACH and regularly looking at the AR agent. Upon move out, right, making sure there's final invoices that are being put in hand or being able to solve that account before residents are out of the building, because again, it makes it very hard to collect once somebody's moved out of the building, right? And now we have aging balances from moved out residents, and sometimes they don't get as much attention, and then they start getting written off, right? So some things that we can do to be proactive to make sure that our P&L, everything that we've booked for revenue, we are able to keep it as revenue and not have to make a bad debt adjustment to reduce revenue in a later period, because that's exactly what's happened. This was revenue in July, but it becomes bad debt in November. And so just think of it like that very simply, and have good and strong processes to make sure that we collecting, right? So we know in our industry, is it possible to have zero bad debt, forever? Right? Probably not, but it's definitely some things that we can do to keep that to a minimum, by some of the things that I just listed, and just making sure that there's eyes on these reports, because we know when it's addressed sooner than later, then there's something that we can do. But it's 3, 4, 5 months and then trying to address it. Now it's like, yeah, even though I owed it, it's so old, and now it's even harder to collect. So anyway, hope that's helpful. Please, please, please take a look at your financials. See if you can identify bad debt. Go ask your executive director what's the policy. Executive director, talk to the operator, talk to your property accountant. Hey, what's our policy on bad debt? Why is that our policy on bad debt? And so when you see it on your financials, go identify your financials. Many of you should be in a position where you can run your reports. Run your report and look for that. Run the balance sheet and look for that, and see and determine, okay, and I see this being subtracted here, and I see that, I know where that's coming from. And now I can also making sure that my team is doing whatever we can do in the business office. Again, our passion is, helping to create business offices that win, right? You're probably a business office that's already winning. Hey, look, we want to come and support to make sure you keep winning, right? We want to give you training material and support that'll help you address issues as they come up, help you shore up controls like around AR to protect your P&L. So, hey, it was a pleasure talking with you. I tell you, I get a kick out of these calls. I really get a chance to just, come alongside you all and support and help, right? So if you got any questions, ask those questions. You know where to find us. These videos are going to hit YouTube. Drop some comments, send a message on LinkedIn. We're on all the social media platforms. Don't hesitate to reach out to us. We truly want to support. It's a passion, as you guys passionately serve our families, right? We want to serve you and go to bat for you. So once again, my name is Burdette Tatum. I am the CEO and founder of Tatum Accounting Services, where we are committed to serving senior living operators in the communities, caring for the residents that we love. Thank you.